All right. Hi, everyone. Happy New Year. Welcome to the first webinar of 2025. Today, we're going to be discussing three topics. Up first, I'm going to be going over the capital gains changes, including where things stand as of this morning, I guess. Next, we'll have Lyle Harvey from our Calgary office discussing the new first home savings account. And lastly, Chelsea Ashton from our Edmonton office will go over some of the tax deadlines you need to be aware of. We're going to be posting this webinar to our website. But if you have any questions during the webinar, please feel free to use the Q&A buttons for this purpose. We'll do our best to answer questions during the course of the presentation, and we will be sticking around for a few minutes afterwards to make sure that we get everybody an answer. Please note, other attendees will be able to see your questions once they are answered. You may also see a couple polls popping up during the presentation. As in past webinars, we are always curious about your thoughts on various economic topics, so feel free to participate. All responses there are anonymous. And lastly, we'll be asking you for some feedback sometime after the webinar ends. Quick disclaimer and reminder that our presentation today is not intended as investment advice, so please feel free to reach out to our team if you'd like to discuss any of the issues presented today in the context of your personal circumstances. We've got our portfolio management team here. And then we'll hop on to our first topic of the day, which is the proposed changes to the capital gains inclusion rate. So real quick, a bit of a refresher on the topic of capital gains. What these are is if you buy, say, a stock for $100 and it increases in value to, let's say, $120, then you have a $20 capital gain. However, the current capital gains inclusion rate of 50% means that only $10 of that $20 that you've earned gets taxed. And it's that inclusion rate, that 50%, that we're talking about today. And the big news is that the inclusion rate may be increasing from 50% to 67%, though for individuals, it only kicks in for capital gains that exceed $250,000. For corporations and trusts, it kicks in right away from the first dollar. Now, the government announced this morning that the original effective date of June 25th, 2024, so a date in the past, has now been changed to January 1, 2026. Now, when this proposal was announced, it was in the context of delivering tax fairness. You may recall that the 2024 budget was titled Fairness for Every Generation. Now, the government had noticed that back in 2021, the top 1% of income earners in Canada had a share of income that was, call it 10.5%. But once you include capital gains in that, their share of income went up to 13.5%. So the top 1% was earning 13.5% of all income. The Minister of Finance, Chrystia Freeland, was quoted as saying that it was possible for a carpenter or a nurse to pay tax at a higher marginal rate than a multimillionaire. And this was part of the reason for proposing the change. Now, one of the issues that was pointed out with this approach is that it's not always the same Canadians who are earning big capital gains. Many Canadians, not necessarily the multimillionaires, own a second property, whether it's a family cottage or a rental property. And as the value of these properties increase over time, these Canadians may be exposed to the higher inclusion rate when they sell their property. So while the tax change is meant to target the top 1%, it may end up catching a lot of other Canadians in the same net. And at the bottom here, a little bit of history on the capital gains inclusion rate. So income taxes were first introduced in 1917, and originally capital gains weren't taxed at all. Tax rates started fairly low when they were introduced, but they rose steadily. So those are the regular income tax rates. But then in 1962, John Diefenbaker with the Progressive Conservative Party appointed a royal commission to propose changes to taxation in Canada. This was known as the Carter Commission because Diefenbaker appointed an accountant named Kenneth Carter to lead the commission. And I am throwing accountants under the bus here just so that no one thinks I'm playing favorites. Now, Carter was quoted as saying that a buck is a buck is a buck. And so it didn't matter whether income was earned as a wage, capital gains, as a dividend, it should all be taxed. So in response to that commission recommendation, a capital gains tax was introduced in 1972 under Pierre Trudeau with the Liberal Party, and that's where the graph starts. Although it's not on the graph, in 1986, Brian Mulroney with the Progressive Conservative Party introduced the $100,000 capital gain exemption so that every Canadian could earn their first 100,000 in capital gains tax free. Then Mulroney in 1988/1990 increased the inclusion rate from 50%, where it was originally introduced, up to 75%. This inclusion rate was brought back down to 50% under Jean Chrétien in 2000 with the Liberal Party, but he also eliminated the general $100,000 exemption, limiting it to only private company shares and farm property. And then finally, we have the proposed increases from Justin Trudeau with the Liberal Party. So I guess I'm pointing out here that both major federal parties have toyed with the capital gains inclusion rate, and obviously accountants played a part as well. So the key point to recognize on this graph is that the inclusion rate of 50% represents the historical low. So there's reason to believe that they can only go in one direction, as they've shown they are willing to do in the past. So where do things stand now? Well, with Parliament prorogued and, there's one of the polls we were talking about. So this first one is just asking about your opinion on whether we're going to see a recession or not. And I suppose that's timely in light of the proposed tariffs coming out of the U.S. They're on and off and appear to be back on again as of today. It looks like the latest announcement is that they're going to start on Saturday. And while those tariffs are collected from U.S. importers, obviously it has an impact on Canadian business. So kind of curious what everyone's thoughts are on what kind of impact we'll see here. And as I watch the numbers coming in, looks like everybody's falling into one bucket, and we'll have Holly, our host, share those results in a couple seconds here. Yeah, so it looks like most of you are saying that you're not concerned. It's hard to predict, but that it's somewhat likely that given the indicators, we'll see a recession or at least a market correction in the next 6 months to a year. All right, thank you everyone who participated. So back to the slide here. And we're just talking about where things stand now with the capital gains inclusion rate changes. So with Parliament now being prorogued, any pending legislation will have to be reintroduced and can, in theory, continue its progress from the previous parliamentary session. However, the capital gains inclusion rate proposal was separated from the rest of the budget, and as a proposal, it never made it past the Notice of Ways and Means stage, which means it would have to be reintroduced from scratch. It's worth mentioning that the rest of the budget measures passed and received royal assent on June 20th, 2024. So therefore, it's an open question as to whether the capital gains inclusion rate changes will be reintroduced and whether they'll actually pass. And today's announcement from the government said that they do plan on reintroducing this here, presumably after March 23rd, 24th, when Parliament resumes. Now, the opposition party under Pierre Poilievre has announced that they will reverse the capital gains inclusion rate changes if elected. And even Chrystia Freeland said she would scrap the changes if elected, and she was the finance minister who introduced them. Mark Carney, Karina Gould, who are potentially running on the Liberal side, seem to be reversing course on this as well. So again, an open question as to whether this actually gets reintroduced and whether it can actually pass. Now, it's worth mentioning that as part of the capital gains inclusion rate changes, there were additional proposals, and these included an increase to the lifetime capital gains exemption to 1.25 million when it was previously roughly a million. And as a reminder, those are gains that apply just to private company shares or some types of farm property. And the announcement today maintains that this change is still going to be effective at the original date of June 25th, 2024. So it's in theory already effective. And the last item is the new Canadian Entrepreneurs Incentive, which would be effective for the 2025 tax year. Again, today's announcement says that these dates remain unchanged. And so I guess that leaves us with 3 new policies and 3 new implementation dates. So we try to maintain a positive attitude when it comes to all these changes, but it can be a little tough with when it comes to the CRA, given that everything that's happening with the capital gains changes and all that uncertainty is coming on the heels of 2 other fiascos. You may recall the introduction of the underused housing tax, which initially required that many Canadians file essentially a nil return or be subject to penalties, and this requirement was eventually reversed. You may also recall the changes to Bear Trust reporting requirements. Again, many Canadians were required to file a nil return or be subject to penalties, and again, this was eventually reversed. In all these cases, Canadians are dealing with a fair amount of uncertainty and the possibility of interest and penalties, let alone the cost of the various filings. And I suspect that accountants especially, but Canadians in general may be feeling some frustration with the process for tax changes, and we're hoping that future governments take a more measured and thoughtful approach. Now, that's all I have. For those who submitted questions, I'll be sticking around to make sure we give you an answer. And now I'll hand things over to Lyle to discuss FHSAs.
Great. Thanks, Steve. So yeah, now we'd like to give you a bit of an overview on a relatively new development called the First Homes Savings Account. So the FHSA is a registered plan that came into effect on April 1st, 2023, which allows first-time home buyers an attractive way to save for the purchase of a new home. The FHSA combines the best of RSPs and TFSAs. Like an RSP, you get a tax deduction on your contributions, and like a TFSA, qualifying withdrawals are tax-free when used to buy a home. Like RSPs and TFSAs, investments gained earned in the FHSA are tax-sheltered. To be eligible to open an FHSA, you must be a Canadian resident, be 18 years of age or older, and be a first-time home buyer. Now, to qualify as a first-time home buyer, you did not at any time in the current calendar year or in the preceding 4 calendar years live in your principal residence that either you or your spouse or common law partner owned or jointly owned. You must open an FHSA account in order to gain contribution room, and the annual maximum contribution is $8,000, and any unused amounts may be carried forward 1 year. The lifetime contribution limit is $40,000, and your FHSA may be used in conjunction with the home buyer's plan, which allows you to withdraw up to $60,000 from your RSP to buy your first home. So in theory, a couple could withdraw a combined $200,000 plus investment growth to put towards the purchase of a new home. Now, your annual FHSA contributions are tax deductible in the year you make the contribution, but unlike RSPs, contributions you make in the first 60 days of the year are not deductible on your previous year's tax return. However, like RSPs, you can carry forward contributions indefinitely and deduct them in later tax year when you may be in a higher tax bracket. Now, as mentioned, qualifying withdrawals, including investment gains that are used to purchase a home, are tax-free. Generally speaking, to use your FHSA funds as a qualifying withdrawal, you need a written agreement to acquire a new home before October 1st of the year following the year of withdrawal, and you must live in the new home as your principal residence, pardon me, within 1 year of acquisition. Also, you must not have acquired the qualifying home more than 30 days before making a withdrawal. So that is to say, you have up to 30 days following your closing date to make a withdrawal. Now, you do not have to withdraw your entire FHSA at once, but you must close your FHSA by December 31st of the year following your first qualifying withdrawal. If you do not make any withdrawals, then you can hold your FHSA until December 31st of the 15th year after opening the account, or until December 31st of the year you turn 71, whichever comes first. And at that time, you may withdraw the funds and be taxed on the gross amount, or you may transfer the funds to your RSP with no immediate tax consequence and no effect on your RSP contribution room. And that's our overview of the First Home Savings Account. So now I'll hand things over to Chelsea Ashton to discuss tax-related deadlines.
Thanks, Lyle. So as Lyle indicated, as always, this time of year, there are some significant deadlines approaching over the coming months that you should note and be aware of. Here's a quick run through of some of those deadlines. So remember that there is no contribution deadline for a tax-free savings account, also known as a TFSA. However, the 2025 TFSA contribution room became available January 1st of 2025 in the amount of $7,000. You can find your cumulative TFSA contribution room on your CRA online account. If you are looking online for your contribution room, bear in mind that the CRA may not have last year's, meaning 2024, contributions reflected yet. T4s, T5s, and most other tax slips need to be filed by February 28th of 2025 and should be available to you at this time. Just as a quick reminder, your T4s are the slips you receive from your employment. T5s are slips that include investment income earned during the year, and T3s, which I'll discuss in a moment, represent income earned on mutual funds structured as a trust. New this year, and something to note, is that in recognition of the Canada Post service disruption we all know and remember, you can claim on your 2024 personal tax return donations made up until February 28th of 2025. This year, the deadline for contributing to your RRSP or your registered retirement savings plan for 2024 calendar year is March 3rd of 2025. This date represents the first working day that is 60 days after year end. And like the TFSA, you can find your personal RRSP contribution room on your CRA online account. Annual trust returns have a filing deadline of March 31st, 2025. T3s, which represent income earned on mutual funds structured as trusts, are not due until March 31st of 2025. And these are slips we often see trickling in through April. The big date, April 30th in 2025, falls on a Wednesday this year, and personal tax returns must be filed and payments made by April 30th to avoid interest and penalties. However, if you have business income or farm income included on your return, the filing deadline is actually extended, and that extension ends June 16th, 2025. Keep in mind with this extension, it does not include payments. Any tax payable is still due April 30th, 2025, whether you have business income, farm income or not. So every year the tax brackets are indexed for inflation. And we have a couple of years here to look at. Federal personal tax brackets increased by 4.7% in 2024. And in 2025, they increased by 2.7%. In Alberta, personal tax brackets increased by 4.2% in 2024 and just 2.0% in 2025. And you may notice, and if you did, good for you, that the 2025 Alberta indexing is actually less than actual inflation. This is because of a new legislation that limits the indexing to a maximum of 2% annually. Something else related to tax brackets that we may see coming in the future, but is still unclear, is a new reduced tax bracket for Albertans. Back in 2023, the Alberta government actually proposed a new tax bracket. So instead of being taxed at that 10% for your first $60,000 of income you earn, you would be taxed at 8%. They have been slow to bring this in, and it has not come in yet. It is proposed that half of this new tax bracket will come into effect in 2026, meaning that it would be 9% on that first $60,000 of income, and the rest would come in 2027. So you would then see that 8% on your first $60,000 of income. None of this has been confirmed as happening yet, but we will see. That's all I have for updates. I am going to pass it back to Steve now to wrap things up.
Thank you, Chelsea. And so the presenters here, we're all going to slip backstage. And I see that some additional questions have come in. So we'll be answering those. And I also see that we've got our last poll. Just kind of asking everybody's thoughts on whether, with all the fluctuations that are happening, how you feel about your current tax strategy. So we'll give you a second for those who are participating to answer that. Always curious what the mood is with our client base. And while you're answering that, I may actually answer one of the submitted questions just here in the webinar, which is around the date for the charitable donations. And so the question is, did the proposal to extend the deadline to February 28th, did that die on the table with all the other legislation when Parliament was prorogued? And my understanding here is that no one's come out to say that they don't agree with this proposed legislation, and that given that it was to recognize the delays around Canada Post, our expectation is that it would still be effective. But you're not wrong. There is actually a fair bit of legislation out there that technically, as you say in the question, died on the table. You never know, we might get some more clarity on these issues with the passing months, but our expectation is that that will go through. All right, so we've got our answer on the Are You Prepared poll. And so looks like quite a few of you are quite confident that your strategy is good. And the winning answer, though, appears to be somewhat confident. So I'm adjusting given the changes, but maybe there's room for improvement. And then we've got a few in the other less certain categories. And as always, that's an invitation. Feel free to reach out to our tax team. You can see Lyle, Chelsea, and myself here. Feel free to reach out if you have any concerns. So like I said, I'm going to slip backstage with the rest of the presenters, and we'll continue to answer these questions. Thank you very much for attending.